So you're a young buck out there looking to retire early with dividend stocks, or perhaps you're a bit more experienced, elder in age, and realize that dividend stocks do in fact possess at least a unique profitable power for all investors. Either way, you're here now watching this video hoping to venture down the dividend investing path with more success, to which I first want to commend you for, and moreover now wish to instill upon you some wisdom that if only I knew at the very beginning of my journey would have made all the difference. And it literally all comes down to just 5 lessons learned. So with that, are you ready? Now, before we kick off into these lessons, the reason I am making this video is simply because I wish you more success than I actually experienced and just want to see everyone actually reach their financial goals, dividend investing or not. But if you choose dividend stocks, then listen up, because these 5 takeaways of mine would have made a world of a difference in terms of where I stand today, which is $203,985.98 within my dividend portfolio. And moreover, whether your goal is your first $100K, doubling to $200,000, or striving for the big $1 million portfolio, all 5 of these lessons will get you there much faster. But enough talking, let's get to lesson numero uno, which is SCHD is not a one-size-fits-all ETF. Now, I know that may hurt some of you to hear, especially amongst the dividend investors who will literally go to war over any negative commentary over the all-famous Charles Schwab dividend ETF. But hear me out on this one. We are all in different positions in life with different goals in mind, as well as different risk tolerance levels and investment timelines, which all just means that as an investor, you need to invest accordingly. Now, SCHD is a reliable fund. That's a fact. I mean, clicking into the fund's overview, we can discover that the fund is going to track as closely as it possibly can the Dow Jones Dividend 100 Index, meaning you'll have exposure to a ton of safety across sectors, with the financial sector that makes up 17.3% of the fund's weight before it taps into healthcare at roughly 15.5% of the fund's weight, consumer staples at 14.2%, industrials and energy at 13.3% and 13% respectively, which work out to a total of 103 holdings, with the top 10 coming down to Lockheed Martin, AbbVie, BlackRock, Home Depot, Cisco Systems, Coca-Cola, Amgen, Bristol Myers, Texas Instruments, and Pepsi. These are all companies that I am sure you know of and deem established leaders within their respective industries, meaning they're very safe investments. But like I said, this is all based on your investor makeup. Now, you may want to consider more growth with a little more risk if you have a lot more time, or heck, just invest in the S&P itself, which, as we can see, performing a simple comparison, SCHD performs slightly over 7% in the year, while VGT is up by 22%, and the S&P itself with SPY is up 18% on the year. But even more power spanning over decades, so if you're closer to retirement or literally in retirement, then sure, SCHD may be your go-to moneymaker. But if I were to go back to my day one, I would be hyper focused on scaling my investment foundation with the S&P itself. Now that we covered some SCHD truths, we can all breathe a little, put our weapons down as we talk about my second lesson learned, which is straight from Warren Buffett's mouth. Diversification is for idiots. Now, in my own words, guess more politely put, less is simply more. And allow me to explain here, because I'm not telling any of you to go all in on just 1 or 2 positions. That would be quite bold, potentially lucrative, but also more of a gambler's bet. We're not in Vegas here. On the other hand, I am telling you to just avoid the mistake that I made, which was investing into dozens upon dozens of positions and spreading myself way too thin. First, there's just no way to keep tabs on 30, 40, or 50 stocks. And if the quote-unquote experts out there can't do it, well, chances are you also don't have the time on your hands to do it either. But more importantly, spreading yourself too thin on positions for the sake of safety is literally what ETFs were created for. And finally, we'll go back to one of Warren Buffett's quotes, words of wisdom to live by, that diversification may preserve wealth, but concentration builds wealth. And that simply comes down to running the numbers. Always run your numbers. If you have $500 or maybe $1,000 or $10,000 and you invest into 30 or 40 positions, that means either less than 100 or 1,000 to each position, which will ultimately yield much less in terms of return on each position, versus remaining hyper-focused on perhaps 5 to 7 positions on top of your ETF to allocate more firepower into high-conviction stocks to really boost your returns. Now, true story, in 2020, I bought a lot of stocks, and I'm still paying the price for that mistake. Moreover, it wasn't really fun collecting 25-cent dividends, and only now, after trimming my portfolio down to under 20 positions, do I really understand just the sheer power of concentration. Which leads me to lesson number 3. High dividend stocks should not be your sole focus. It all comes down to total return. Now, high dividend stocks can in fact provide exceptional opportunities for the savvy investors who are out there, the far few and few between. And if you are honest with yourself, I mean, let's just be real. Who wouldn't want to jump at the opportunity to earn a sky-high yield on their investment? But the reality is, investors need to be wary of chasing high dividend stocks, those 9+ percenters. After all, if something sounds too good to be true, it usually is. Now, a company's high dividend might be because its stock has actually suffered a significant drop in share price. That ultimately means there's financial trouble brewing and its ability to make future dividend payments is on the line. For example, say a company trades at $50 per share and pays a $2.50 annual dividend for a 5% dividend yield. Not too shabby. But now let's say that a negative external shock like a 2020 scenario sends the stock to $25 per share. The company may not cut the dividend, therefore at a superficial glance, the company would appear to now be trading at a heck of a discount with a 10% dividend yield, leaving you with your jaw dropped. However, that yield actually may only be temporary. The same catalyst that cratered the entire stock price there could lead the company to reduce its dividend. Now, on the other hand, a company might elect to keep its dividend yield intact as a reward to all the loyal shareholders out there like yourself if you're chasing yield. Thus, investors should just look at a company's financial health and operations to actually determine whether that dividend payment is going to be sustainable over the long period of time. Don't chase yield. Let me just tell you now that you don't want to be the fool holding the bag of a dividend trap, as the stock itself will drive itself and all your hard-earned capital to the grave. Yes, AT&T and 3M, I'm looking in your direction. However, you need to consider your age and investment timeline here as well. If you're on the younger side, I say just seek dividend growth stocks, given companies that consistently boost their dividends generally have exceptional free cash flows, strong balance sheets to actually maintain the dividend payments over the long period of time and grow them. Now, not only that, but they exhibit above average revenue growth. Personally speaking, and just based on where I'm at today at 30 years old, I am hyper focused on dividend growth stocks with yields ranging from less than 1% to 3.5%. And as I get closer to retirement, I'm going to adjust that number accordingly. But for now, ideal power plays are Visa with a 0.76% dividend yield that we can see has soared by over 432% over the last decade. United Health with a 1.51% dividend yield that has appreciated over 700% over the last decade, or a play like Apple with a lower yield of 0.43% but has launched over 900% over the last decade. Now, total return is just where our focus should be, whether we're dividend investing or not, which now leads me to my 4th lesson learned. But investors, before I actually share it with you, I want to ask for your help directly in helping me reach my goal of getting that 70+% of you out there watching but not actually subscribed down to at least bare minimum 50%. Ultimately, you keep tuning in, but just haven't actually joined the journey. And little do you know how far that action actually goes on my end. And with that comes my commitment to you all to continue to produce videos like this or dish out new stock ideas, market insights, and just have better guests to join me on Masters of the Market. Now, while you're at it, tap on that thumbs up button to actually let me know that this video has delivered some value to you, so I know to continue to produce content just like this moving into the future. But with that out of the way, let's talk about my 4th lesson. Monthly dividend stocks are sexy, but not marriage material. Now, what exactly do I mean by that? Well, many of us are adamant about buying monthly dividend stocks over quarterly paying dividend stocks because, as it would appear, you would essentially have more money in your pocket every single month, which to some extent, yes, there is truth there. But also, if that's the sole reason that you're investing into these dividend stocks, I gotta ask you why you're investing in the first place. For money to spend now, or because you think that reinvested capital would roll a bigger dividend snowball faster for you? But sheer experience speaking, it once again just comes down to the quality of your investment. And moreover, there are some significant drawbacks of monthly dividend stocks that you need to know about, like the fact that distributing dividends every single month requires more frequent processing, accounting, and management of cash flows. This actually increases operational costs, meaning companies are technically less profitable if monthly dividends come with an extra cost to process. But not only that, companies might struggle to maintain a consistent monthly payout, especially during periods of financial hardship and instability or economic downturns, like over the last year or two. And finally, from a market psychology standpoint, the frequency of dividend payments might influence investor sentiment. Monthly dividends can be perceived as a sign that a company is prioritizing short-term income over long-term growth. Incredibly important there. And while this is technically true, this perception might deter long-term investors then that are more interested in the company's actual growth potential, which is what you should be interested in. Now, even Brian, the CEO of Simply Safe Dividends, shared with me directly on Masters of the Market that actually a lot of these monthly payers are quite dangerous, which is why we could see lower dividend safety scores across all of them on Simply Safe Dividends if you check out their site. Let me just now explain with an analogy. Monthly dividend stocks are really quite simply the girl in the red dress. You know, sexy and will give you fast cash, but ultimately quality dividend stocks, you know, the ones that you can enjoy over the long term, are usually the ones that you want to marry. You know, we're talking about the modest, respectable types that continue to deliver and remain there for you no matter what. In other words, don't just date your dividend stocks, marry them. And with marriage comes the task of actually weeding out the candidates that are not really going to suit you or that aren't aligned with your long-term goals. Now, with that in mind, I want to get now finally to lesson learned number 5. If you want to get rich, especially with dividends, feed the fire. In other words, do not stop investing on a daily, weekly, or at bare minimum monthly basis. Personally, growing up, I always had a job, whether it was mowing lawns or gardening, washing or waxing cars, or in the winter, bigger payout days that came from shoveling snow from my neighbors' driveways. And then as I grew older into my teens, I was a busboy, a waiter, a pizza delivery man, fitness trainer, and even got involved in a lot of MLM businesses. The point is, I was always out there making money, and I missed out on thousands of dollars by simply not being invested into the market. I'm not going to punish myself too hard now because I was young and naive then, but I started my investment journey actually in college with a lump sum of money and just let it sit there. And while yes, it did grow over time, I didn't get that compounding eighth wonder of the world effect until I really began taking investing seriously, dollar cost averaging into the market in reverse order from what I shared with you. So monthly, then weekly, and now almost daily. But just to share with you the sheer power of dollar cost averaging to enjoy the firepower of compounding, let's take my roughly $20,000 that I had at the start of my journey, put it into the market for 50 years with an average return rate of the market, which is about 7%, and then we're going to do nothing with it over that period of time to get $569,140.50. Not too bad considering I started with 20 grand. However, if I was smart and decided to really go after financial freedom like all of my life depended upon it, because in reality it does, let's say I actually put in $1,000 every month, which I hate to burst your bubble is actually very doable for everyone if you work hard enough without excuses. You could see a total return now that soars to over $4.8 million for only contributing $620,000 over that time. So listen up, enough with Starbucks coffee runs. Think twice before you buy clothes that are just going to hang in your closet after 1 or 2 wears. Dine out once a week as opposed to 5 or 6 times a week. Hang in versus hanging out. So you can actually double up on your investments and then become financially free and do all that money wasting business later on. Now, investors, and knowing these 5 takeaways of mine, I am sincerely now wishing you all the best and more on your journey, but would certainly love to know some of your biggest lessons learned thus far. So comment down below. Be sure you're subscribed to the channel, but also just be sure to dive into more insights right now by clicking right here, and I'll see you in the next one.